Hey everyone, welcome back to the channel where we talk dividends to help you grow your wealth for the long term. Today I want to dive into one of the most talked about dividend stocks out there, Enbridge. Now, if you're someone who loves the idea of getting consistent growing dividends and has an eye on long-term capital appreciation, this one is for you. So grab your coffee and let's talk about whether Enbridge is still a good buy heading into 2025 and beyond. First, let's talk about the company's stock performance. Right now, Enbridge is trading at around $60 per share, which is close to its multi-year high. In fact, the stock is up around 25% this year, which is a solid run. Speaking of dividends, this is what Enbridge is all about. They've increased their dividend for 30 consecutive years, which is longer than many of us have been investing. Their most recent dividend hike was a 3% bump, and the stock is now yielding a 6.25% dividend. That's a juicy yield for anyone looking to build passive income. Plus, with the growth in their cash flow, we can reasonably expect these dividends to keep climbing in the future. So, what triggered the rally since June 2024 for Enbridge? Well, the big catalyst was Bank of Canada and later US Federal Reserve starting to cut interest rates. If you remember, the hikes we saw in 2022 and 2023 really put pressure on dividend-paying companies like Enbridge because they use a lot of debt to fund growth. Higher rates meant higher borrowing costs, and naturally that spooked investors. In addition, the bond market took some money out of dividend-paying stocks, as it tends to do when interest rates are higher. But now, with the rate cuts rolling out full steam, the narrative has flipped. And as always, investors started to pile into many dividend-paying stocks, such as Enbridge. Retail investors do this every single market cycle, which is why it's important to understand and remember that the best time to buy is when there's peak fear levels in the market, like we saw in 2022 and 2023. As for example, with Enbridge, you could have bought the stock for as low as $43 per share, which would have locked you in at 8.5% dividend yield. This rate cut environment is actually a double win for Enbridge. Not only does it ease concerns about their debt expenses, but also makes future growth projects and acquisitions more attractive. And let's be honest, Enbridge doesn't shy away from growth. This year, they completed a massive $14 billion acquisition of 3 natural gas utility companies in the United States. That move made Enbridge the largest natural gas utility operator in North America. Enbridge is positioned perfectly for the long term, as oil and gas demand is expected to continue to grow for decades to come, along with growing and new types of demand such as from AI data centers, crypto mining farms, new types of manufacturing, and gas power plants for gas, and developing nations' growing demand for both oil and gas. On top of that, they've got a massive long-term $27 billion capital program in the works. We're talking infrastructure projects that are expected to boost EBITDA by 7 to 9% annually through 2025 and 2026, with earnings per share expected to grow by 4 to 6% annually, and distributable cash flow expected to grow by 3% annually, and likely well past beyond 2026. These growth numbers might not sound flashy, but they are consistent, and for dividend investors, that's gold. But what about the risks? Because no investment is perfect, right? One concern some investors have is whether Enbridge growth is too dependent on debt. While lower interest rates are helping now, any significant future rate hikes or economic downturns could impact their borrowing costs and share price negatively. However, these risks are not Enbridge specific, as it would apply to many dividend-paying companies. There's also the broader energy transition to consider. However, Enbridge is diversifying actively into renewables and LNG projects to diversify from a focus on oil and gas, and even so, many developing and third world nations will continue to depend heavily on legacy sources of energy such as oil and gas for many decades to come. In addition, on December 17, 2024, Ottawa abandoned its net zero by 2035 goal. This will benefit Enbridge substantially, as this reduces the focus on renewable energy and made regulations more flexible around gas power generation, which will drive demand for more gas. So, should you buy Enbridge now? Well, it really depends on your goals. If you're an income-focused investor, Enbridge's stable and growing dividend makes it hard to ignore, especially with a 6.25% yield. You can essentially lock in that passive income stream while benefiting from steady cash flow growth. Just don't forget to build positions over time using dollar cost averaging to ensure to take advantage of any stock price dips. Either way, Enbridge is a stock that deserves a spot on your watch list and maybe even in your portfolio. If you're focused on long-term income and moderate yet reliable growth. Alright, that's my take on Enbridge. What do you think? Are you buying, holding, or sitting on the sidelines? Drop a comment below and let me know. And if you found this video helpful, don't forget to like and subscribe. Thanks for watching, and I'll see you in the next one. Take care.